Welcome back to the Deep Dive. So if you're watching the finance world, you've definitely seen this major tech struggle playing out.
Oh, yeah, it's everywhere.
You've got TradFi, traditional finance, right?
Yeah.
And they really want what blockchain and DeFi offer that speed. Things like instant settlement, programmable money, even better digital ID.
Absolutely. The potential is huge.
But, and this is the huge but, they just cannot give up their absolute requirements for security, for privacy, and especially for regulatory compliance. It's non-negotiable.
And that's the fundamental paradox, isn't it? It's what's really held back widespread institutional adoption for years now.
So,
Well, public blockchains, they give you amazing integrity, real transparency. But that transparency, it's a massive problem if you're talking about, say, secret trading strategies or, private customer data.
exactly. It's like wanting the engine of a race car, but needing it to be library quiet and completely invisible. That's the friction. And our sources today really zero in on this specific friction point. They detail a very particular architecture.
Yeah.
It's metal blockchain's approach, custom built, they say, for banks, credit unions, fintechs.
Right. And so our mission for this deep dive is really to take that specific blueprint apart. We want to understand the mechanics they're proposing.
How does it claim to let a bank or whoever get those blockchain benefits while keeping those essential compliance guardrails locked down?
It's all about enabling that innovation, but doing it with, let's say, institutional level confidence, not just hoping it works out.
Okay, let's jump right in then. The foundation seems to be something they call Institutional Private Subnets. Now, that sounds kind of technical, maybe a bit jargony. What does that actually mean for a bank in practice? Is it just their own private little blockchain?
Think of it more like a custom-built digital zone, maybe. They are definitely dedicated, they're specific to certain applications, and crucially, they're permissioned.
Permissioned, meaning not just anyone can join.
Exactly. It's like a walled garden. Access is strictly controlled, only known, vetted, regulated players get in. So the bank itself, maybe key partners, and importantly, the necessary authorities.
Okay.
And they're really designed to handle the kind of high-speed, sensitive stuff a financial institution does every day.
Got it. And that word private, that immediately seems to tackle the first big hurdle, right? Confidentiality. If a big bank is shifting billions in assets, tokenized or otherwise, they can't have that splashed across a public network.
Precisely. And the source material really hammers this point-home data separation as key in this architecture.
Separation how?
Transactions, sensitive internal records, all that stuff stays encrypted and confidential strictly within that private subnet.
Okay.
Which is critical. It means, your secret sauce trading algorithms, customer account details, specific trade histories, none of that ever needs to hit a public open ledger. It keeps that standard of privacy that TradFi has always relied on.
That makes sense for privacy. But here's where, you have to apply some skepticism, I think. The compliance angle.
Always the tricky part.
If these subnets are so private and encrypted, how do they possibly meet the need for audits, for regulatory oversight? You can't just tell, say, the Federal Reserve, sorry, it's too private for you to look at. That's obviously not going to fly.
Right, and they know that. That's the sort of necessary trade-off built into the design. The architecture actually calls this feature regulator-accessible.
Regulator-accessible, okay.
So while it's private from the general public, yes, it's specifically designed with controlled entry points for auditors and regulators.
Controlled entry points. So it's not like a wide open back door, but more like a specific secure viewing window they can use. We probably need to understand what that access entails. Is it like a constant live feed for the regulator? Or do they need to request access with credentials? Because that distinction matters for the bank's independence.
The way it's described suggests the second option more focused on secure, permissioned review. So regulators, other necessary authorities, they can examine the on-chain data when they need to. This seems to solve that critical compliance problem without blowing up the day-to-day confidentiality. It's about meeting the legal need for transparency to the authorities, but not sacrificing the business need for, keeping your operational details private from competitors.
And the argument would be, if the data is on an immutable ledger within that private subnet, its integrity is solid when the regulator does look.
Exactly. The integrity of the data itself, when viewed by the proper authority, should be, unquestionable.
I see. Okay, so the private subnet handles the transaction privacy and gives regulators a controlled way in for audits. But that leads to maybe the biggest question for this whole setup, doesn't it?
Which is?
If this custom chain is all self-contained, How does it get that core promise of blockchain, the real trust, the transparency, the integrity that comes from decentralization? Why isn't this just a very fancy, secure corporate database at the end of the day?
Right. And that's where the hybrid nature of this model really comes into play. It's all about the connection mechanism. The diagram in the source material highlights this.
The connection. Yeah, the private subnet, it runs the actual transactions, handles the operations, but it doesn't exist in a vacuum. It's fundamentally anchored to a public chain.
Anchored to the public chain. And in this specific architecture, that public chain is the metal public chain. They call it the X chain.
Correct.
So, okay, here's the crux. How does a sensitive internal transaction happening on the private subnet talk to this global, transparent X chain without revealing all those sensitive details we just talked about protecting?
It doesn't send the details. It uses a process the source material labels bridged audited settlement.
Bridged audited settlement. Okay.
What actually gets pushed out or bridged to the public exchange isn't the raw transaction data like who sent what to whom or the amount. Instead, it's a cryptographically secured commitment or proof.
A commitment, like a mathematical fingerprint.
Sort of, yeah. Think of it like pushing out a hash or maybe a Merkle root or potentially even a zero-knowledge proof commitment, something that acts as an undeniable, immutable public receipt that something valid happened on the private chain at a specific time. Okay, let's pause on that. So the transaction happens privately. The private subnet does its thing, agrees on the transaction, finalizes it.
Yeah.
Then it generates this proof, this commitment.
Mm-hmm.
And that proof is what gets sent out to the public exchange, which then records it.
Precisely. The exchange's role here is providing that essential layer of transparency and global verification for the settlement event, not the underlying details.
Ah, I see.
So once that cryptographic proof is logged on the public, decentralized ledger, the exchange, it inherits the security and immutability of that whole public network.
Meaning if someone later questions whether a settlement really happened inside that private subnet,
the institution can just point to the public unchangeable record on the exchange. It serves as definitive proof of finality verified globally.
So, okay, the public chain isn't for the day-to-day transaction flow. It's purely for security anchoring and providing that external proof of settlement.
Yeah.
That feels like the key difference between this kind of hybrid model and just trying to do everything directly on, say, a public chain like Ethereum.
Mm-hmm. Absolutely. You hit the nail on the head. If a major bank tried to settle huge volumes directly on a standard public chain, they'd leak far too much sensitive information.
Right.
But if they kept everything completely internal, purely private, they'd lose that global immutability, that resistance to censorship or manipulation that a truly public, decentralized chain offers.
So the X chain acts like a global public notary for what happens inside the private institutional walls.
That's a really good way to put it, yeah. A distributed, transparent notary service for the operational subnet.
And bringing those two pieces together, the private operational side and the public verification side, that's the synthesis where the value proposition really lies, isn't it?
It seems to be. It lets institutions keep that competitive shield around their internal operations, but at the same time, they can ensure their key settlements are verifiably secure, final, and recorded on a globally trusted ledger. It manages the trust issue by separating the different concerns.
Privacy here, proof there.
Exactly. And that separation is why this kind of architecture is being positioned as that necessary bridge, finally connecting TradFi with the useful parts of DeFi.
Oh, so?
Well, it means institutions could potentially start using things like smart contracts, tokenization, that whole idea of programmable money, but within their own private controlled sandbox, all the while knowing that the ultimate integrity, the final settlement proof, is secured by public decentralization.
Okay, thinking about comparisons.
Yeah.
How does this differ from, say, older approaches like traditional consortium blockchains, things built on platforms like Hyperledger Fabric, maybe? They also offered permissioned access.
That's a really important distinction to make. Yes, consortium chains are permissioned, but typically their security and integrity still rely on a relatively small, known group of participants agreeing and validating. It's still a form of centralized trust, even if distributed among a few players.
Right, you trust the members of the consortium.
Whereas by bridging these settlement proofs out to a truly public chain like the X chain,
But tapping into something bigger.
you're leveraging the decentralized security of a much wider public network for that final audit trail and proof of finality. This significantly reduces the need to implicitly trust just the other members of your private subnet. The ultimate security guarantee comes from the broad, trustless public network, not just the governance rules of a small club. That seems to be the innovative step here.
Okay, so moving from the technical mechanics to the bigger picture. Yeah. If we accept, for the sake of argument, that this kind of dual structure, private subnet plus public anchor actually does solve those major hurdles of privacy and compliance,
Right.
what does that unlock immediately? What kind of financial products could institutions start building or deploying more easily?
Well, the sources strongly suggest this makes things like programmable digital assets and much faster cross-border settlement suddenly way more practical.
Okay, like tokenized real-world assets.
Exactly. Imagine tokenizing something complex like a commercial real estate loan or a specialized bond. The private subnet could handle all the messy, confidential details, the legal checks, the ordership transfers between regulated parties. But the public exchange just needs to verify that a legitimate final transfer occurred without needing to know all the underlying specifics.
Which could dramatically speed things up, right? Improve liquidity. You cut out a lot of manual back office work, potentially shorten those long T+ settlement cycles.
Precisely, all while keeping the sensitive details private between the involved parties. And maybe even more transformational is the potential for instant, guaranteed cross-border payments and settlements. You could imagine banks in different countries running their own region-specific private subnets, adhering to local rules.
Right.
But then they all use the single shared global exchange for the final immutable reconciliation of funds between them. That could genuinely rewire how international payments work.
Yeah, that moves this whole blockchain for banks conversation away from just theory and towards actual practical deployment scenarios. It stops being about if a bank should use this tech and becomes about how they integrate a hybrid system like this to fix real business problems they have today.
Indeed. And you can see why the creators frame it as welcome to the future of digital banking. The potential appeal is that clear separation. Operational speed and privacy happen here in the subnet, and external immutable proof and integrity happen there on the public chain.
Okay, so that brings us to our final thought for you, the listener, to maybe chew on after this. We've unpacked how this specific dual architecture, these private institutional subnets anchored by the public X chain, is designed to get around those big privacy and compliance roadblocks that have really slowed down banks getting into blockchain.
Right. So if we assume for a moment that this core friction is largely resolved, that institutions do now have a toolkit that feels viable and, crucially, regulation-friendly, it sparks a really interesting next-level question. Given the potential speed, programmability, and security guarantees this kind of hybrid setup offers, what kind of complex financial instruments, think really intricate structured derivatives or maybe highly personalized insurance contracts based on real-time data, things that are just too complex or opaque to manage efficiently today? Could this architecture finally make feasible to automate and deploy on a global scale?
What new forms of financial innovation get unlocked when that institutional confidence barrier is lowered? That feels like a really big question here. Thanks for joining us for this deep dive.
See you next time.